on behalf of Sean, thank you for his own set of SAS manuals. Wasn't that the gift from CARE to him? Was mom and dad each have theirs, and now baby Sean has his own set of SAS manuals. So, no, actually, we're back into the short selling world. We have Kumar Venkataraman, who is from Southern Methodist University, PhD from Arizona State, another finance guy. So going to teach us a lot more about how markets work, specifically, again, diving into a little bit of a proprietary data set, trying to understand how, this is my take on the paper, trying to understand how people decide which firms to short. Go ahead, Kumar.
Thanks, Greg. Charles provided a wonderful lead-in for this paper, because where Charles left off was, what do these guys really know? And I think some of the empirical evidence that we have here relates to some information on what these guys might be trading on. Before I go on, I want to thank Peter for the invitation and for a wonderful conference. I'm really enjoying myself. This is a joint work with Hemang Desai, who's my colleague at SMU, and Srini. And our paper is looking at the role of fundamental analysis in information arbitrage. So here's a presentation roadmap that I have in mind. Talk a little bit about the related research and motivate our paper, then talk about the data set and the model, which is trying to model the behavior of short sellers, trying to understand how these guys identify their target firms. And our variables are motivated by the contextual analysis. So in the context of this specific problem, short sellers are interested in identifying firms that subsequently perform poorly. So some of the variables that we're going to use relates to other research in the literature which have looked at the predictive ability of variables to predict returns. Then an important piece of our analysis relates to the validation of this model. There are some concerns with this data set, just because it's a very small data set. So it raises a question of, can these findings be generalized, which I think is a very, very important concern. And so we'll present some results on the ability of the model to predict both short interest and future returns in an out-of-sample period. And then we present one application of the model on distinguishing between valuation and arbitrage-motivated short selling. The previous two papers this morning are very much have very much set up this question in our mind, because we know that short selling aggregates different types of motivation for short selling, and so we want to know whether we can distinguish between the two of them. So that would be an application. And then time permitting, I would like to talk briefly about another research project that I have with my colleagues Hemang and Neil Bhattacharya. Okay, now prior research tells us that there are various valuation and financial statement variables that predict future returns. For example, fundamental to price ratio has been examined in Lakonishok, Schleifer, and Vishny. Momentum has been examined in Jagdish and Titman. Earnings quality or accruals has been examined in Sloan. And the importance of fundamental analysis has been shown in several papers. And I apologize if I don't have a complete list of some of the work that people in the audience may have done related to this topic. For example, Abarbanel and Bushi show that a trading strategy which looks at a combination of various financial statement variables helps generate abnormal returns. Now, there's a lot of debate in the literature on what do you make of these findings. So the debate relates to whether these abnormal returns are simply picking up mismeasurement of risk, that is, we don't have a good benchmark model, and therefore it's simply not picking up risk, or are these because of methodological biases, specific sample periods over which this analysis is run, or yes, these results are there from a paper portfolio perspective, but when you move to the real world where you really try to implement these strategies, you will not generate any alpha because of significant market frictions. That's another line of reasoning, and that relates to the limits to arbitrage and costly short selling and transactions cost type explanations. And then, of course, we have the fourth interpretation, broadly perhaps, which relates to mispricing, which says these are mispricing opportunities, and you can, in fact, generate abnormal returns based on these strategies. So the objective of our paper, the idea of our paper is the following. We said, well, what do information arbitrageurs do? What do the smart market participants do? So information arbitrageurs are market participants who we think identify mispricing. These are the smart traders and take positions and forces prices towards the fundamental value. That's the typical definition of information arbitrageurs. So in this study we said, well, let us directly examine what information arbitrageurs do. Do they really trade on information in these types of fundamental and valuation signals? If all the abnormal returns that have been documented can simply be written away by risk or friction or methodological biases, then we probably will not expect to see a strong relationship between the trading behavior of information arbitrageurs and the information contained in these signals. On the other hand, if we do find a relationship, perhaps that's informative about whether there are market participants who actually trade using this information. Now, many in the audience are the information arbitrageurs, and they know what they're trading on, but there's really not much of an academic evidence on this topic, and that's where we would like to come in. And really, it's not because people haven't thought about the question. The real big problem is data availability. We have to identify information arbitrageurs, know what their positions are, know what their trading strategies are, and we don't have good data to do this. Now, there is a related literature on short sellers which suggests that one subset of market participants who might be these information arbitrageurs is short sellers. And the previous papers have presented research along those lines suggesting that these guys are smart traders. And the basic intuition is as follows. If you think about the institutional details of short selling, if you think about the various costs and risks associated with short selling is costly and it's risky. So you have the direct cost of short selling, and I think Adam would be talking more about that in the next paper. Some firms are not allowed to short sell. For example, mutual funds may have specific requirements that they're not allowed to take a short position. And the market microstructure of short sales introduces a risk of a loan recall. So a lender of a security to a short seller can call back that loan at any point in time. And if the lender does that, then the short seller needs to find another lender to hold on to the position. And if that short seller has difficulty in finding another lender, then he may have to close out his position prematurely. So think about a .com stock which someone may have shorted at $100. The intrinsic value is much lower, say it's $10. Stock price has just gone up to $120. The lender calls back the loanable shares. The short seller is not able to find another lender. He's forced to close the position at 120, and he makes a loss, although it's a profitable position. So there are various kinds of costs associated with taking on the short position. And so theoretical models, having thought about these costs, suggest that short sellers tend to be informed traders, just because short selling is costly and it tends to therefore drive away some of the uninformed traders from assuming short positions. And there's a lot of empirical evidence suggesting that short interest predicts future returns, both at the daily and at the monthly level. There is evidence suggesting that increases in short interest conveys negative information about firm value, all of which suggests that short interest itself is informative for returns. So our research plan here is to examine the trading behavior of short sellers. Now, if we think about examining the trading behavior of a particular market participant, say analysts, then we can do that by looking at analyst recommendations. Or if we want to understand institutions, then we can understand that by examining institutional holdings. However, the problem again is data. Unfortunately, there is no publicly available data with broad coverage on either short seller recommendations or holdings. But what we do have is the aggregate short interest data, which speakers earlier today have talked about. There have been two strands of literature, I think, which I would like to emphasize today on short interest. The first one examines which stocks are difficult to borrow. And many of this line of research looks at proprietary stock loan data. Charles has an earlier paper in which he looks at what happens in the 1930s in the New York Stock Exchange, when there was actually a market in which you can observe the lending rates for difficult to borrow stocks. There are other studies, including one by Adam Reed, which looks at the same information. And they have identified certain characteristics which are associated with difficult to borrow stocks. The other line of research says that let's examine the aggregate short interest and see what kind of firm characteristics is it correlated with. What might be short sellers trying to trade on? And an important paper by D. Chow and co-authors show that the aggregate short interest is related to valuation multiples. There's some research suggesting that it's related to accruals and to post-earnings announcement drift. My co-authors and I had a paper that was published in the Review of Accounting Studies last year, which shows that short sellers seem to be taking positions prior to earnings restatements. So our event is the earnings restatement. We go back about 12 months, and we examine the behavior of aggregate short interest. And what we document is that the aggregate short interest goes up significantly before a restatement, suggesting that these guys may be able to predict these restatements. Ed Swanson has another paper which documents similar results. And the other thing that we do in our paper is then we cut the data on the basis of accruals, say 12 months before, information that's available to short sellers before the restatement. And when we do that, what we find is that the increase in short interest before a restatement is significant for firms with high accruals, suggesting that these short sellers target firms with poor earnings quality. So that's at least one data point suggesting that maybe short sellers are indeed sensitive to information contained in financial statements. And this research is a follow-up, really, to the prior paper on understanding short seller behavior. So the assumption in this line of research is that the aggregate short interest really is picking up the short selling made by these informed traders who are targeting overvalued securities. That's what we call valuation shorts. But as has been discussed earlier today, the reported short interest aggregates both valuation shorts and arbitrage shorts. And arbitrage shorts represents short selling that is motivated by various kinds of hedging or arbitrage strategies, such as convertibles arbitrage, merger arbitrage, index arbitrage. Charles just presented results suggesting that 25% of the short sales on a daily basis represents program trades. So this is a significant component of the short interest that you might observe. And disentangling what is valuation short and what's arbitrage short seems to be getting more and more important, because the predictive power of valuation short, which is really a take on the future returns of the firm, the future performance of the firm, is very different from the predictive power of arbitrage shorts, which are simply hedging strategies. So it's very important to disentangle valuation shorts from arbitrage shorts. And I think this is becoming even more important moving forward because of the explosive growth in institutions which are engaging in various kinds of market-neutral, long-short type strategies, which are closely related with arbitrage shorts. In a recent paper, Asquith and co-authors show that the predictive power of short interest has declined over time, and they attribute it to the higher incidence of arbitrage shorts, which really don't have much of a predictive information for future returns. So what do we do in this paper? We examine a database of short sale recommendations made by an independent research firm for its institutional clients. What is the advantage of examining short sale recommendations? Each of these recommendations are purely motivated by an impression that this stock is overvalued. So we suggest that this is a more precise signal of the demand of these valuation motivated short sellers. But this has some limitations, and I will talk about that in just a minute. So using this short recommendation data set, we build an empirical model of the trading behavior of valuation shorts in our estimation period, which is from 1997 to 2004. And yes. A sell recommendation from an analyst, is that what you think? that specifically is short sale about this. It's essentially a signal suggesting that this security is overvalued in their impression. So typical short recommendation would be a report that this firm puts together for its institutional clients, articulating reasons why it believes the stock is overvalued and why it believes the stock will do poorly moving forward. In many of these discussions, they talk about the quality of earnings. They talk about why they believe some of the reported earnings may not be sustainable. Sometimes they talk about valuation, sometimes about industry factors. But essentially, they are suggesting in this report, they're recommending that you take some kind of a short position. That is, if you are already long, you may want to get out of it. If you don't have a position, then you might want to take a short position. But it's essentially a negative signal on the future prospects of the firm. Correct. So this is not from the IBIS. These are not analysts. This is a firm that only finds out targets for short selling. That's what they do. And they provide their recommendations to institutional investors who subscribe to their data set and then who trade on it. Okay. So we built an empirical model using these recommendations. And what we find is that many of the accounting variables play a critical role in identifying these targets. So for example, we find significant association with sales, SG&A, gross margins, and accruals. We also find that the recommendations are related to book-to-market ratios, momentum, and liquidity. So these findings suggest that there seems to be a relationship between the literature on return predictability, which have looked at many of these signals and documented their relationship to future returns, and the trading behavior of information arbitragers, who are the informed market participants, the short sellers, who seem to be playing an important role in keeping prices efficient. So that's one contribution of our paper. And we validate the model during an out-of-sample period, and we present an important application of the short interest model. So that's really what we do in this paper. So here are the testable hypotheses. The first one is related to what I put up in the first slide. Do information arbitragers attempt to exploit the predictability in fundamental and valuation signals? It's likely that they do. Those of you who are market participants here who trade probably know the answer to that, but this is an attempt at coming up with a more rigorous academic approach to examining the same question. And secondly, the big concern with this approach is to what extent is it generalizable, right? Because we have a single research firm making about 60 or 70 odd recommendations that we use in our empirical analysis to come up with a model. How do we know that this model really is picking up the trading behavior of informed short sellers, which is really what we would like to claim? So this is what we do. We go to an out-of-sample period, and in the out-of-sample period, we show that we attempt to test, and that's our second hypothesis, whether firms that we identify as being the targets in the out-of-sample period indeed have high short interest. Because if they are the targets of informed short sellers, we should observe high short interest. And two, if indeed they are representing valuation shorts as against arbitrage shorts, then the returns of a portfolio of these short recommendations in an out-of-sample period should be significantly negative. So those are our two tests to validate this model in an out-of-sample period, given the obvious limitations of using only a single research firm in our analysis. And then finally, we go to the question that's been raised this morning, which I think is getting more and more critical, which is, can we use the model? So if we have a big portfolio of high short interest firms, can we use the model to differentiate between firms which are valuation shorts and which are arbitrage shorts? Okay. So if a firm has high short interest and our model says that it is a valuation short, then those firms should exhibit negative abnormal returns. On the other hand, if a firm has high short interest, but our model does not identify it as a valuation short, we classify it as an arbitrage short. And if our classification is indeed correct, these firms should not exhibit negative abnormal returns, because these are not valuation motivated shorts. These are simply hedging related shorts. And further, we need to show that these arbitrage shorts, as we have identified, should exhibit characteristics that are associated with arbitrage strategies. For example, they should have a higher proportion of firms in the S&P 500 index, if these are indeed index arbitrage shorts, or they should have convertible bonds outstanding. So these are some of our tests to support, empirical tests to test our hypotheses that I just outlined here. Okay. The sample picks up every short recommendation issued by the research firm since its inception in 1998 until June of 2005. We have 67 firms in our sample. As I said, the report presents arguments detailing why they expect the performance to reverse. And in panel A up there, we provided some information on returns. In the prior 12 months, you can see that these firms have experienced a sharp run-up in price. Month 0 is the month of the short recommendation. During that month, there is a negative return that you observe, and you observe negative returns over the next 12 months. Now, what we did was, we said, what exactly are these negative returns? What are they being driven from? Can we identify what are the events that seems to be causing these returns to be negative? And so what we find here is that many of the news that comes out over the next 12 months relates to either reporting lower than expected earnings or lower guidance issued by the firms or some kind of a downgrade. For example, this is Rite Aid. The short seller recommendation was issued here in November of 98. In March of 99, Rite Aid announces that its earnings are going to be lower than what the analysts are expecting. Interestingly, on March 13th, which is the next day, Rite Aid comes out and it says that it is under investigation by the SEC regarding its earlier accounting filings. And as you may recall from many of the press reports, one wonders whether our research firm or their group of short sellers were anywhere related to being the useful tip that regulators frequently receive, right? Those are some of the articles that we read about in the newspaper. Nonetheless, that gives you a sense of some of the bad news. Very important to state two things. First of all, not every firm in this database has negative news. There are some firms, and we talk about that in the paper, where you find spectacularly high returns. So it's not as though every firm that's identified by this short seller does poorly. That's important for us to remember. And two, although these returns are informative, these may not be the returns earned by short sellers, actually, because you could have a case where subsequent to the recommendation, the stock price really goes down and it reverses, and a short seller might get out after 3 months instead of waiting for 12 months, which is what we report there. Similarly, it might be the case that subsequent to a short recommendation, the price might run up, and then it might go down significantly, and a short seller who does not have deep pockets might need to get out of that position at a loss. So keeping those limitations in mind, nonetheless, these numbers here suggest that on average, these guys seems to be able to predict returns, and that a lot of these are related to poor performance with respect to earnings, suggesting that perhaps that's what they're targeting. Here's a main model. It's a logistical model. I will not have the time to go into all the details of how the model is estimated, but you have all the information in the paper. Estimated annually, so we take snapshots of our variables every September. The sample period is from 97 to 2004. In terms of identifying our financial variables, we relied on Benish 99 paper on identifying firms that manipulate their earnings. And this is in the context of our specific application, which is to understand the behavior of short sellers. The short seller is interested in identifying firms that subsequently do poorly, and this is consistent with the objective in Benish analysis. And so we went with those variables. Incorporating accruals here is picking up on our prior work, which suggests that they seem to be sensitive to earnings quality. Also, using a variable such as Benish, I think also makes everybody who reads the paper a little bit more comfortable, because these are variables defined by an earlier study, and so not really constructed by us in the context of this particular analysis. So I think it just makes it a little bit more easier to present. We also include performance measures following Di Chow et al., momentum, and then some liquidity characteristics as control variables. And what do we find? We find that short recommendations are more likely to be issued for firms with increases in sales, SGAI, and gross margin, for firms with high accruals, and for firms with low book to market, high momentum, and high liquidity. And in fact, yesterday when Doug was making his presentation on what do they use at Moody's KMV to identify firms that might get downgraded or might perform poorly, you may recall that they were using abnormal increases in sales or gross margin as variables in their own model, and it was kind of comforting to know that similar results are obtained in our analysis as in some of their analysis. So what are the implications? Well, first of all, I think the question is, hey, do information arbitrageurs actually trade on these predictability from the earlier literature? And it looks like there is a relationship between the literature on the predictability of fundamental signals and the literature on the trading behavior of information arbitrageurs. They seem sensitive to information contained in accounting ratios, and in particular seem to target firms with poor earnings quality. If you recall, I told you that the firms in the short recommendation experience a sharp run-up in price. If you go back to the momentum effect documented by Jagdish and Titman, the momentum effect says that firms that have high abnormal return over the prior 12 months continue to do well. So it looks like what these short sellers are able to do is identify the subset of these high momentum firms whose performance is not sustainable. And it looks like they're able to do so by using many of the financial statement variables. So perhaps this is an example of the importance of context-based fundamental analysis that has been examined well in the literature. Yes? Sure. Increases in sales, that's right. The intuition, we think, is in conjunction with the first bullet point and the second bullet point. So if there's a firm that documents a big increase in sales and many of its operating performance measures, but at the same time also has high accruals, then together it might signal that perhaps it's not sustainable. Yes, that's an excellent point. Unfortunately, I didn't have time to say this, but all the financial state. I think the question was, would it be more informative if you do some kind of an industry adjustment? And I think that's. Okay. Okay. Examine components of accruals. Okay. I think we can do that. We haven't done that. We just stayed with accruals, industry-adjusted accruals, total accruals, operating accruals, but we can. They do. So we have access to all their short recommendations. Actually, we have stayed away from using the variables that they use. Okay, in the following sense. For example, we know that they use institutional ownership. We know they don't use accruals. To them, it was informative that accruals in our empirical analysis fits in with some of the things that they're doing. So our interpretation in terms of what's going on here is not that, as I will show you in a few slides, this model is able to predict the aggregate short interest in an out-of-sample period, suggesting that there is information here which is correlated with the trading behavior of short sellers in an out-of-sample period. Our interpretation is not that every financial variable here is really what a short seller is using. However, the information here is correlated with whatever financial variables they're using, and therefore it has the predictive power. So to answer your question, we did not use exactly what the research firm used. simply because that's not our objective. Our objective was to kind of fit it within the broader context of the literature, stay away from any concerns about whether our model was super fitted for the particular short recommendation. That's why our variable definitions here completely are consistent with Benish, which is a prior work in the literature. And so that's really to kind of address some of those concerns about whether we're overfitting the variables to the data. And really, the big question is the out-of-sample predictability. And we could have. I think that can be done. We just didn't go down that path, but that can be done. So then we bring up the question, can these findings be generalized? The model is based on a small sample of short recommendations by a single research firm. Does the model predict short interest in an out-of-sample period? And does the model predict returns in an out-of-sample period? So in our out-of-sample analysis, we examine the period 1990 to 96 because, as you know, our sample goes from 98 to 2005, so we really don't have much data subsequent to the estimation period. So we examine a period prior to that, and what we do is we pick up the coefficients from the short interest model over the estimation period, and we use it in conjunction with the firm characteristics that we have identified in the out-of-sample period to come up with predicted probabilities. And then we sort the overall sample on the basis of predicted probabilities and break them up into decile portfolios each year. And what we report here are the average short interest as well as the pharma fringe calendar time regression alphas for the different portfolios based on predicted probability. And interestingly, what we find is that firms with the highest predicted probability have the highest short interest. As you can see, there's a monotonic trend in short interest in an out-of-sample period. And so what does this mean? First of all, the fact that this model is able to predict short interest ratios in an out-of-sample period suggests that this is indeed capturing the trading behavior of short sellers in aggregate. And two, it tells us that short sellers in aggregate indeed are trading on information that's correlated with these fundamental and valuation signals. It may not be the same signals, but it's correlated information that's being picked up by the model. And in terms of a calendar time regression alphas, as you can see, firms that have the highest predicted probability of being a valuation short have the most negative returns, and firms which have the lowest probability have positive returns. Now, here's a graph which documents the trend. We use many different models, and this is the abnormal returns. Now, we run a whole bunch of robustness analysis that we talk about in the paper. We look at operating accruals versus total accruals, industry adjusted versus unadjusted measures, momentum measured over 1 year versus 6 months, turnover, trading volume, 4-factor model including the Carhart momentum factor. We control for learning effects, which is essentially the question of whether the short firm, this independent research firm, actually looked at data from 1990 to 96, built a model, and then used it subsequent in its recommendation. And if that is the case, then the earlier time period may not be really an out-of-sample period in a true sense. And so what we do is we break up the 97 to 2004 period into smaller periods. We build a model over the first half, test it out-of-sample over the second half, and we find broadly similar results. Yes? So we sort it on the basis of predicted probability, and then we look at the short interest for each of the buckets. So these are the ones that are reported earlier were the actual short interest. Yes? Exactly. So we do exactly what you asked, which is so in this table here, these are the actual short interest for these different buckets, suggesting that indeed, in aggregate, the model is able to predict what firms have high short interest versus firms that don't. us look like if they're sorted on actual short interest? We haven't looked at that, but I think you would probably find that firms with the high short interest would be the firms with the most negative returns. I think that's what prior research has shown us, that firms with high short interest exhibit negative returns. We haven't looked at that though. I'm not sure how it fits in with. Maybe we can talk later about it if you have a suggestion along that line. And then we run some other, we exclude low price firms. We run a different alternative methodology for picking up control firms. Now here's our approach to distinguishing between valuation and arbitrage shots. So every year we pick up firms with the highest short interest ratio and the lowest short interest ratio. So we take all the firms, look at the short interest, sort them into 10 buckets. We take the firms with the highest short interest and the lowest short interest. Then independently, we break up the overall population into firms with low, medium, and high predicted probability from our model. And our expectation is that firms that have high short interest and high predicted probability, which would be firms here, are the firms that are valuation shots, because these are identified by our model and they also have high short interest. On the other hand, firms that have high short interest but low predicted probability are the firms that are identified as arbitrage shots. So if that is indeed the case, then what we should find is that firms that are identified as valuation shots should exhibit negative abnormal returns, which is what we find here. On the other hand, firms identified as arbitrage shots should exhibit no evidence of negative abnormal returns, which is what we find here. And this is another interesting bucket here, which is these are firms that our model says should be targeted by short sellers, but for which we observe no high short interest. So the question is, why are short sellers not loading up on those firms that our model says they should load up on? And one possibility is that these might be short constrained firms. So to provide additional evidence for our classification, we examine firm characteristics. So in terms of firm characteristics, if indeed the firms with high predicted probability and high short interest and low predicted probability, which are our arbitrage shots, if indeed these are arbitrage shots, then they should have firm characteristics consistent with some arbitrage strategies. So what we find is that indeed they do have a higher percentage of firms with convertible bonds outstanding, a higher percentage of firms which are members of the S&P 500 index, suggesting that perhaps short interest in these firms are driven by arbitrage strategies. Similarly, firms that we think should be shorted but are not are smaller and less liquid firms, suggesting that short sellers may not be taking positions in these firms because they are too risky or they may be difficult to borrow stocks, and so they're short constrained. So in conclusion, this study provides some new insights into the information arbitrage process using a short sale recommendation data set. We find that there's a relationship between the trading behavior of information arbitragers and some of these fundamental and valuation signals. The big advantage, or one advantage of this approach, is that short recommendations might be a more direct signal of valuation shots than the aggregate short interest, which aggregates both valuation and informed shots, and whose predictive power, prior research has shown, seems to be declining. And we present one application, but I think there are several applications that can be further looked into. We don't report the results in this paper, but in a prior draft we show that the short interest model can help distinguish between firms with high momentum that subsequently do well versus those that do poorly, suggesting that this might be another signal that market participants can use in terms of their trading behavior. How many minutes do I have? 2 or 3 minutes. Okay, 2 or 3 minutes. If there are any questions, I can take them, or I would like to talk briefly, just briefly about a paper. Adam? The question is, are short sellers simply responding to the report that we have? I don't believe so, in the sense, okay, so the way we tried to go after that question was to examine important news events for these firms over the next 12 months, as I showed you in one of the earlier tables. And we document that many of these firms have negative news, which is correlated with earnings. For example, the firm comes out and says that our reported earnings are going to be lower than what the analysts expected, or they lowered the guidance, or there is an analyst downgrade. So at least the evidence seems consistent with the fact that short sellers are perhaps able to recognize that based on their fundamental analysis, the negative surprises that subsequently come out, and they take positions early on. And then when the negative surprises comes out, you observe the stock price reaction, which generates the returns. It's consistent with that. Okay. Just briefly, I want to talk about a paper that I'm working on with Neil and Himan, who are my colleagues at SMU. So there's a big debate in the literature on what are the adverse consequences of poor earnings quality. And there's a paper that I'm sure many of you are familiar with by Francis et al., which shows that earnings quality may be related to the cost of capital. And there are several papers that have subsequently been written which, question some of the findings and which ask whether indeed that is the case. So what we do in the paper is the following. If we think about the link between earnings quality and cost of capital in the Francis et al. Paper, they're looking at earnings quality. The notion is that poor earnings quality increases information asymmetry. Information asymmetry is a non-diversifiable information risk in the portfolio, rebalancing sense, in the context of Easley O'Hara, and that in turn affects the cost of capital. That's really the link. Now, when